Hello everyone, my name is Jeffrey Kennedy and welcome to Trader's Classroom. Before I get too deep into today's lesson or today's presentation, I just want to make sure everybody can hear me okay and also see the chart movement. I'm going to be moving charts from my right over to my left, and I just want to make sure everything is okay. Hello, Andre. Good to see you. Hello, Tim. Nice to see you as well. A lot of familiar faces in today's room and also a lot of, I guess, guests. So thank you. If you've never joined me before, thank you for joining me today. Oh, wow, Romania, all the way from Romania. That's pretty awesome. I've never been to Romania, and I've always wanted to go. I'll have to put that on my bucket list. I have done some extensive traveling over the years, but I've never made it to Romania. Okay, well, thank you for joining me today. I've been to India. I love India. I fell in love with India. I was in Mumbai a few years ago. Been to Italy, been there. Never been to Iran. I would love to go. I'm always open to new experiences. Nepal, that's pretty cool. Thank you for joining me. Wow, this is quite the international group here. Wow, Pakistan, Colombia, Saudi Arabia, Indonesia. Wow, this is pretty cool. I don't think I've had an event yet where I've had such a international, say, clientele or guest list. This is pretty awesome. Well, thank you so much. Nigeria, awesome, awesome. Well, thank you for joining me today. Okay, today's lesson is going to be a little bit different. Now, I'm not really big into self-promotion. I have an entire marketing department at Elite Wave International. I like that. Dante, thank you for that one. Yeah, but I'm not really big into self-promotion, as I just said. We have an entire marketing department at Elite Wave International that handles that sort of stuff. My focus is more education and helping people become better analysts and better traders. That's my passion. My passion is teaching, trading, and technical analysis. And for those of you who have been subscribers of mine over the years, know that. Now, about twice every year, in the fall and in the, say, summer, I do a course. It's a 5-day course, Monday, Tuesday, Wednesday, Thursday, and Friday. And the course, each lesson, like, for example, Monday, I'll be doing like about an hour-and-a-half lesson. And what we'll be doing through the week is really focusing on well, what I hope to, the ultimate outcome is to be better traders. So I put together this series several years ago called The 4 Critical Elements of High Confidence Trading. So what I wanted to do with a portion of today's live event is just kind of go into a little bit more, say, detail, not too much detail, but a little bit, just kind of explain a little bit about how I look at the market, not only from an analytical perspective, but also from a trading perspective. And I'm doing this so that if you're interested, you can click on the link below and, you know, kind of find some more information. So if you'd like to join me for next week, you're more than welcome to come. I will say this, the coursework is fairly fast-paced. It's a lot of information, a lot of detail, and I don't really think it's appropriate for the beginner. So if you're still, say, struggling with your core or basic Elliott wave formations, I don't think the class or the coursework would be appropriate for you just yet. Maybe come the summer session. Maybe at that point you might be a little bit more comfortable with things. Or if you don't understand what an option is, if you don't know what an option is, or if you've never traded options before, then I don't think the course would be really, I don't think you would be able to get as much as you'd actually like. But if you kind of find yourself in that intermediate to, say, advanced category, then I think you would enjoy the course. I certainly have had a lot of positive feedback over the material and over the presentations for the last several years. Okay. So let's kind of get started. And I'm not going to really be talking about analysis so much as I am about trading, because I tend to describe myself as an end user of technical analysis. I do perform technical analysis in order to identify what I consider to be, say, a high confident trade setup. Okay, and there's several components to, I believe, becoming a consistently successful trader. Number one, you got to have your head right. You're thinking. A lot of what we do as analysts and traders is actually very contrary type thinking. You have to be able to manage your emotions. Your emotions and your own individual psychology, I think, in many ways, is going to be the ultimate determinant of your trading success. Also, too, I hope to, within the coursework, get you to a point where you can look at a price chart and go, okay, hey, I have a viable trade setup here, I have a high confidence trade setup here, I have something worth actually taking a shot at, versus, hey, I'm looking at this price chart, I see nothing, I'm going to take a hard pass on it. So those are some of the goals I hope to accomplish. So let's go ahead and get started, and once I'm kind of through with the initial presentation, and then I'll look into then I'll open the floor for some questions. Okay, let me see, Trevor. It's pretty much the same coursework, the same material, although the examples that I go through, as far as like my own individual trades, I've updated a lot of that stuff. So it's not going to be that different from what you've already learned. Okay, so the 4 critical elements of high confidence trading. I think one of the key elements of being a successful analyst and being a successful trader is you have to have a disciplined way of looking at the market. Okay, and the disciplined way, ultimately, it's going to be whatever you decide what works best for you. Okay, I have a very disciplined way of looking at the market, and essentially I am a trend trader. I think that is the most consistent, profitable way to trade financial markets. I'm not looking at trying to pick the top. I'm not trying to look to pick the bottom. I'm basically looking for a market that has a clearly well-defined trend, and then in an uptrend I buy pullbacks, and in a downtrend I sell bounces. It's very similar. And much of my approach to the market has been taken from and adopted from some of the best traders in the world. If you have not had the opportunity to read any of the work by Jack Schwager, J-A-C-K, Schwager, S-C-H-W-A-G-E-R, his Market Wizards books are absolutely phenomenal. And those books that he has put together, he's written, are merely just interviews with the world's best traders. I'm talking the traders that are making like $100 to $200 million a year or more, those guys. I found it very valuable to learn from these guys, because a lot of these guys, of course, are technicians. Some are fundamentalists, some are quantitative guys, but a lot of them, of course, are technicians. Tom Joseph, of course, is one of the world's best traders, and he's very much a fan of the Elliott wave principle. Okay, so my style of trading is very much trade in the path of least resistance. So in a bull market, I tend to buy pullbacks, and in a bear market, I tend to sell bounces. So trend analysis is pretty much my go-to, my starting point. And then, of course, from there, I look for patterns. Patterns I recognize. And these are going to be Elliott wave patterns, okay? Zigzags, flats, triangles. The 5 core patterns, kind of what I hammer you with pretty much throughout the year in Trader's Classroom. And it's not just limited to Elliott wave patterns. Head and shoulder formations. I like those formations. The double failure swing high, the double failure swing low. One of my favorite trade setups, as you well know. So we look at different types of patterns, but primarily Elliott wave patterns. And then momentum work, momentum and Japanese candlestick work. Momentum is very, I think, very important. I rely heavily on, say, for example, RSI and stochastic, but as you well know, there are several, hundreds, literally thousands, if not, different types of technical indicators and oscillators you can use to view momentum or understand momentum. If a market is really taking off and it's got wind under its wings, or it has legs to it, or if, hey, a market is actually struggling to make new highs. Japanese candlestick analysis. As many of you well know, Japanese candlestick analysis was introduced to the West by Steve Neeson. It's a style of analysis that's been around for a few hundred years, actually, and its origins go all the way back to the rice markets in Japan, I think, if I got my memory correct here. Haven't had enough coffee for today. But it works. I like Japanese candlestick analysis, and I think Japanese candlestick analysis, momentum analysis, and the Elliott wave principle, they're all three distinctly different forms of technical analysis, but I think they all fit very well together. For example, whenever I'm looking at a price chart, what the wave principle allows me to do is basically digest and interpret a massive amount of data very quickly and very easily. So I can basically pull up a price chart, look at 2 years worth of data and go, okay, hey, this is a developing impulse wave, or this is we're working a triangle over the last 6 months. Well, the opposite of that is actually Japanese candlestick analysis. With a knowledge or understanding of Japanese candlestick analysis, what you can actually do is look at a single day's trading or the last 2 or 3 trading days with a candlestick price chart and understand who's in control of the market, the bulls or the bears. And that's why we rely on those Japanese candlestick reversal patterns, the bullish engulfing, the bearish engulfing, 3 white soldiers, 3 black crows, piercing patterns, dark cloud cover. So what the wave principle does, it gives me a big picture view. It's kind of like looking through the world with binoculars or a telescope, and Japanese candlestick analysis is like using a magnifying glass or a microscope. It allows me to zero in. And then momentum, of course, allows me to say, verify structure. And we use that by primarily relying on, say, for example, RSI. That's my primary tool for that. And much of my RSI work I learned from a good friend of mine, good colleague, Andrew Cardwell, who taught me how to do that. So those are primarily, this is my discipline. This is my framework. And just so you know, I'm not offering this information as, hey, this is the only way to be a successful trader. I'm not doing that. Or if I'm coming across as, hey, if you're not doing it my way, you're doing it wrong, I'm not saying that either. I'm just saying that everybody's path, everybody's journey is going to be a little bit different. And what I'm sharing with you is essentially the end results of my journey over the last, say, 20 years of being initially not a successful trader to ultimately a successful trader. So I'm offering these tools as, hey, if you're not looking at the market this way and you're not happy with the results that you currently have, maybe try and look at it a little bit differently. So I'm hoping this information might help, can't hurt, might help, and it may get you to where you ultimately want to be. Then we have on Thursday, we'll be doing an overflow session. Okay, and that's where I basically play catch up for the week. As I said, there's a lot of information contained in the coursework. And then on Friday's the fun day. Friday is basically where I put away my PowerPoint presentations and I stop talking about what I want to talk about and we start talking about what you want to talk about. So if you're interested in crude oil or silver or Apple or commodities or soybeans or whatever, it doesn't matter. It's your time to ask questions about anything and everything and look at your markets. And again, not necessarily ask the basic questions of, hey, what do you think about the S&P or what's the wave count here? Those really are not the appropriate questions, or at least those are not the questions that have the most significance or the most meaning to me. The most meaning to me, or the most relevant question is, when I look at a price chart, I want to be able to go, okay, hey, do I have a trade here? Is this a market worth trading? Is this an opportunity on a chart where I actually, see the potential of actually making profit? Okay, so let's go ahead and get started. I just kind of want to walk you through the process. Okay, so the first step, as we well know, is going to be trend analysis. And Unity Software is a company that we were looking at, I think, last week or the week before. And what kind of caught my attention initially on presenting this would be the double failure swing low Up, down, failure swing number 1, up, down, failure swing number 2. Price action we've recently seen over the last, say, 4 to 6 weeks certainly has all the earmarks of a third wave. So I'm looking at this, and basically the trend analysis is quite easy to see. From the low that we saw here back in, what was that, May, up to what we are currently seeing, prices are moving from the bottom left-hand corner of the price chart to the upper right-hand corner of the price chart. In other words, the trend is up, okay? So right there, that determines my trading positions. I want to be a buyer, okay? I'm basically looking to buy. And I want to buy pullbacks. I want to buy weakness. It could be big weakness or long weakness, or it could be a short-term weakness. But number one, I'm essentially looking for buying opportunities, again, because the direction is up. Then I like to apply my step number 2. What's the wave count? Well, as you can see in recent days, recent weeks, we've seen the penetration of the upper boundary line of the base channel. For those of you who are familiar with the Kennedy channeling technique, this essentially confirms the presence of third wave price action and argues that we do indeed have farther to go to the upside. So between now and current levels and, say, moving forward into probably May or June, I'm looking for this puppy to continue up to, say, 275 a share. So I definitely think there is still plenty of upside potential here for the swift and nimble trader. Okay, so now that I've done my trend analysis and I want to basically buy pullbacks in an uptrend, I have a good understanding of the wave principles, so I know what to look for. Basically, I'm looking to take advantage of counter-trend price action. Counter-trend price action would be a zigzag, a flat, a triangle, a double 3 or a double zigzag, a double flat, or a combination of either of the patterns. So I'm essentially looking to take advantage of weakness. Now, on a short-term price chart, and this is one of the things that we did not do last week when we were looking at this issue, was I drove it down to the smaller term time frames, because on the smaller term time frames, I can then begin to zero in on, say, my entry points or my exit points. I can begin to zero in and basically ask those questions. Okay, how much money am I looking to risk versus how much I'm looking to trade, profit from, if I'm indeed correct in my analysis. I like options, so I tend to trade options. Now, I know enough about options to be dangerous to myself and others, which is why in Trader's Classroom, I do not talk or discuss option trading. I do not know what a bull put ladder is. Yes, I'm familiar with the terms butterfly or condor or a butterfly with broken wings. I understand those more, say, advanced option type trading strategies, but I do not know the subject matter well enough to teach it, which is why I don't attempt to teach it, okay? What I do know is, hey, if I like something and I think it's going to go up, I'll buy calls. If something's going to go down, then I buy puts. It's pretty simple. That's my approach to option trading. And I've been doing this approach for more than a decade, and it works for me. Okay. Now, within going back to unit here, the substructure, what really catches my eye about this is this move right here. Okay. That move right there. And let me be precise. So I'm going to put some arrows on the chart. From the low that you see right here, that low, to the high that we saw right here, okay, how many waves do you see within that advance? Hanson, I used KCT was designed and built utilizing nothing but arithmetic scale charts, linear charts. I don't use it on a log. Okay, 3. Okay, the answer is 3. Everybody's telling me that there's a 3-wave move from that low to that high. Okay, so we have a 3-wave move to a new high. What Elliott wave structure, what Elliott wave pattern allows for a 3-wave move to a new high if we're thinking corrective patterns or corrective structures? Zigzag, flat, triangle. Well, it's certainly not a zigzag because, you know, wave B of a zigzag cannot ever retrace more than 100% of wave A. Wave B of a flat, though, can do so. So that means the odds of this being, if I'm correct with my interpretation, then this is a flat counter trend move. This is a flat fourth wave. Okay, as such, we've come down into appropriate Fibonacci support, the 382 50% retracement of wave 3. We're right at the, say, the boundary lines of the KCT channel. That's a secondary use or value of the KCT approach. The base channel trend lines often provide support for wave 4. So this is looking good. I like this, okay? Now, from there, I don't want to stop here. I do not, remember, the field of technical analysis is very rich and very diverse. There are several disciplines. You have point and figure. You've got Wyckoff. You've got Elliott. You've got candlesticks. You've got Dow theory. There are many, many different disciplines under that umbrella term of technical analysis that us as professional technicians actually use and we're familiar with, okay? Now, that being the case, I don't like to rely on a single tool. I don't see the necessity or the need. By using one single tool, I think it basically diminishes my ability to analyze and trade the markets. Also, too, if these other tools do indeed work, why not use them? So what I like to do is I like to look at a market from many different angles, many different perspectives. So if I'm looking at the market from, say, candlesticks, and I'm seeing something that is suggestive of bullishness, and then I'm looking at the market from an Elliott wave perspective, and the implication or the conclusion is that I'm also looking at a bullish market environment, then what I'm looking at is I have multiple different disciplines, multiple different approaches, multiple different techniques that are basically saying, okay, hey, the next move should be to the upside, and that the risk is, minimal to the downside. So this is where we begin to pull in some of our momentum work. Okay, now there's a signature that I talk about in Trader's Classroom, and I've pointed this out. We've had several lessons on this, and it's the value of RSI bull market support and RSI bear market resistance. And again, I learned this from my good friend Andrew Cardwell. Now, whenever you're in a bull market or an uptrending market, whenever you see weakness in that market, it tends to react at or near RSI bull market support, which is that area between 50 and 40. Okay. At the same time, my own little twist to Andrew's work is I'd like to see an oversold stochastic. Okay. So the current pullback right now in a Unity software, ticker symbol U, is very similar to actually what we saw back here on November 3rd. So I'm seeing a momentum pattern, which is an agreement as far as identifying this as a counter trend move within a still larger uptrending market, which is exactly what my Elliott wave analysis is calling for. And then from there, what we do is we then look at our candlestick price chart, and one of the reasons I value this page, this is one of my technical pages, we've talked about this before in Trader's Classroom several times. What I have here is, of course, Japanese candlesticks, and then I have a 5-period %R and a 20-period %R. Those two tools, %R, was developed by a brilliant analyst and quite the character, Larry Williams. Now, the blue lines that you see in the top window pane here, those are Donchian channel lines. Donchian channels were developed by Richard Donchian, who's considered to be, the father of trend trading or trend analysis. And the reason I like that tool specifically is because if you look over to the left-hand corner portion of the price chart, you'll notice something quite interesting and quite repetitive, and that is counter trend movement tends to act or occur right at the Donchian average, okay? So we saw that right here as well. And hold on, let me get the line here. I can't get the line. Okay, I'll use that line. Notice where we are on this current pullback. So this is an optimal place to actually be looking for a reversal in price. That idea is provided by the Donchian channel. So now what I would like to see here, maybe move down to a smaller term time frame and examine some candlesticks, maybe 60-minute. Okay, we're getting some bullish engulfing patterns. We're not yet above that Donchian channel just yet, but this is something that I'm going to be keeping an eye on moving forward as we move into the next few trading days and certainly into next week, Because if everything goes according to plan, we're going to rally from current levels at or near current levels as we anticipate this fourth wave low forming, and then that would give a rally up to ideally maybe say 230, 240-ish. We're currently trading 180. That's a nice trade. Okay. Now we're going to repeat the process again, and I'm going to show you again how I look at the market. This is my disciplined way of looking at the market, and I don't care what your approach is, but it needs to be disciplined and it needs to be consistent. I spent several years playing hopscotch, and what I mean by that is several years ago, early in my career, this would have been back between say 1995 and say 2005, I was a big fan of one of my favorite magazines, and this was Stock, what's the name of the magazine? Stock Analysis and Commodities. I was even in the magazine. It was Stocks and Commodities and Analysts. It was a magazine geared toward technicians and technical analysis. And so every month the magazine came up and came out. I would read the articles. I would just peel through it over on the weekend. And typically every month they would have a new indicator or a new oscillator, and I would fall in love with it. And so I would begin to incorporate that new indicator or that new oscillator into my work. That was fun. It was certainly educational, very insightful. But the problem was that my approach to the market was always changing. Okay, and so my approach to the market wasn't consistent. Thus, my results were not consistent as well, because I was always chasing the next best, greatest idea or market. In other words, it was like I always felt that the grass was greener on the other side of the fence, so I'm always jumping fences. That's not necessarily true. The grass is not always greener on the other side of the fence. It's simply that the other people on the other side of the fence, they have just a different set of problems than you do. Okay, let's look at another market. Okay, this will be, hold on here, AMC. I've been watching AMC. Earlier this year, it got a lot of attention, got a lot of, say, volatility to it, and I've been watching it, okay? And I can see that, okay, hey, from the lows that we saw here, we seem to be moving up. And after the big spike high here we saw back in May and June, we kind of settled down. But one thing that I do recognize from the chart is price action has been really compressing here. Now, this compression could be good or it can be bad, okay? This could be like, say, for example, A, triangle BC, where we're headed down to $20 or $15 a share, or this could be a triangle fourth wave. I don't know, okay? But whenever I put on a trade, do I know I'm going to be right? Well, it's 50-50. It's hit or miss, okay? This is why risk management is so important, okay? Because if you don't trade trades that have less than, say, a 1 to 3 risk-reward ratio, you can be right only half the time and still be a consistently profitable trader, okay? It's all in the numbers, okay? So here I like the idea that this is a counter-trend move within a larger uptrending market. This is kind of what I was thinking as the week unfolds. We talked a little bit about AMC, I believe, last week or the week before. I like the triangle idea, A, B, C, D, maybe wave E. If we look at the short-term structure, again, maybe wave E, maybe, again, the big question is maybe. Now, the one thing about triangles, and I mentioned this in my book, The Visual Guide to Elliott Wave Trading, written by Wayne Gorman and myself. The reviews on Amazon are fairly good. It's been out there for several years. But in the book, I talk about triangles and how to trade triangles. The biggest problem with a triangle from an Elliott Wave perspective and from a trading perspective is we're always tempted. There seems to be like a subconscious urgency to identify the completion of a triangle done before it actually is. So this is why I put some parameters, something that I refer to as confirming price action. I want to see some confirming price action before I actually begin pulling the trigger or green light myself to trade. Now, what do I mean green light myself to trade? Basically, whenever I green light myself to trade, that basically means I'm giving myself permission to actually take positions, okay? Until then, I'm watching and waiting, and I spend 80% of my time watching and waiting, okay? The other 20% of the time, things are crazy because I'm in the market, okay? So with the triangle, just I'm watching and waiting, and I think the breakout's going to be probably somewhere between 44 and 46. So until we get that breakout, I'm just going to continue to watch and wait on this one, and that's what a trader does. I'm waiting for the opportunity. Now, ideally, what we'll see is from current levels, maybe we push down a one, maybe we come down one more time, okay? Don't know, don't care, because I'm not in the market yet. I'm waiting for that optimal time to jump in. It's kind of like when you're a pedestrian. You're walking down the street, you're walking on a sidewalk, and you want to cross the street. You want to cross, 4 lanes of traffic, okay? You just don't say, hey, I'm going to cross the street because I want to be on the other side of the street and just walk out into traffic. You don't do that. What you do is you stop, you look left, you look right, you look left again. You make sure that there's plenty of time for you to cross the street without getting hit by a car. And when you think that opportunity is optimal, where the risk is the lowest it can actually be so that you don't get hit by a car, that's when you begin walking across the street. And that's when, in my opinion, it is appropriate to trade. So what I would like to see here with the sequence of events I'm looking for in AMC moving forward would be for prices to get above this 44, 46 handle. And then at that point, come back down, because many times what you'll do whenever you punch through an area of resistance, you have what they refer to as a throwback, okay? And that's very telling as well. Because whenever you see a change in function of resistance and support, support becoming resistance, resistance becoming support, that sort of thing, then that's really what aids you in being, say, confident that you're indeed seeing a change of trend. So rather than doing something here, getting, say, ahead of myself, over my ski tips, I'm not buying AMC with a stop at the wave C extreme. That is not the way I recommend on how to trade a triangle. What I'm looking for is the confirming price action that argues that the triangle is indeed complete, and then my focus is going to be on positioning myself on following the first primary counter trend move within the developing new upward sequence. So probably maybe come early December or mid-December, there might be an opportunity here. So maybe during the holiday season, everybody goes out and sees a movie. Maybe that's what pops the market here. I don't know, don't care. Then, of course, we also monitor our momentum. Now, what I see here, which is very suggestive of a big move, is the moving average compression. Notice how the moving averages are coming compressed, just like they did back here. In a lot of ways, this price action that we've seen the last few months is very reminiscent of what we saw back here between March and then April and end of May prior to the big pop-up. Maybe lightning does strike. Of course, we look at our candles, okay? Not really seeing much on the candles, although we have a very small real body. That indicates indecision. We have some very long lower shadows. That tells us the market is rejecting lower prices. We are currently working for the week a bearish engulfing pattern, but we're still stuck in this consolidation, so these candlestick patterns are not as effective in a sideways market. Nonetheless, if we do get above last week's high here, then that would leave behind a failed bullish engulfing pattern, which I would interpret as bullish. So as far as AMC goes, I see some opportunity, but it's not yet ripe. I need to give it a bit more time. Look for that market to ripen up before the fruit is worth picking. As far as Unity, this is kind of a holiday week, so I don't do much during holiday weeks. But come next week, this might be an opportunity because, again, one of my favorite market timing techniques is to look for significant highs or significant lows to form early within the beginning of each new month. And you would be surprised at how often that actually does indeed occur. So that's what I'm thinking here in these two issues, but also too, I just kind of wanted to walk you through briefly, albeit briefly, the process, my logic, my discipline on actually how I go about looking at a particular market. I start with trend first and foremost, and then I want to deal with some type of recognizable Elliott wave pattern. And then from there, that's when I want to pull in my momentum, and then I want to pull in some candlestick work. And then at that point, maybe it would be appropriate to say transition from a daily chart level down to an intraday chart level to kind of fine-tune my entry point and where my, say, initial protective stop might be. Always, always, always manage risk. That's what professional traders always are doing, managing risk. Okay, so let me see. Luca, no, this is a arithmetic scale chart. Okay. Okay, Trevor, is there a Fibonacci relationship between wave 1 and wave A, B, and C? Well, it depends on the positioning of the ABC, Trevor. If it's a wave 2, then the most common Fibonacci retracement is going to be 618. You should know this, Trevor. The most common Fibonacci retracement for wave 4 is going to be a 382 of wave 3. Wave B, if you're working a zigzag, your retracements most often are going to be 382, followed by 618, followed by 50%. If you're working B of a flat, then you're going to be looking primarily for at least an 80% retracement of wave A and wave B. Of course, with a zigzag as well as a flat, you're looking primarily for equality between those two moves. Okay, any questions on what I've covered? Okay, you're welcome, Trevor. Mohammed, you're a subscriber to Traders Classroom. Well, of course, I think there's information in the four critical elements series that I think would be helpful. The real question is, do you think it would be appropriate for you right now as far as your education? Again, the coursework is really not designed for someone who's a beginner. It's more for the intermediate to the advanced student. So if you think, you know, that's where you're at and you would like to maybe, and you're not pleased with your own performance and you're maybe looking for something that might help, then, you know, take a look at what we're doing here. Brian, exactly. Okay, let me see, question here. Okay, Alex. Okay, why use an arithmetic chart and not a log chart? Okay, Alex, good question, and let me kind of explain that. If you study the coursework of or the material offered by the Market Technicians Association, the idea or what they basically say was whenever you're looking at a price chart and the ratio between the low of the chart and the high of the chart, if that ratio is greater than, say, 1 to 3, then it's appropriate or most appropriate or more appropriate to look at the chart in what they refer to as log scale, sometimes referred to as a percentage chart. So this would be a log scale chart, okay? So this is a log scale chart. And as you can see, my triangle doesn't really change here. I prefer, I know what the Market Technicians Association says, but I prefer to look at charts using arithmetic or linear scale price charts because once you begin doing this, going from arithmetic to log, well, you could argue that this is nothing more than a form of data manipulation, okay? So it's more of a personal preference, I think, for you know, whatever works for you, stick with it. If you like log scale price charts, then don't let me talk you out of using log scale price charts. It's just more of a personal preference of mine to stick with a linear scale price chart. I know it looks a little bit odd sometimes, but one of the techniques that I rely on quite heavily is a technique I developed years ago called KCT, the Kennedy channeling technique. And when I developed that technique, which is basically, you know, a trend line technique that allows me to differentiate between impulse waves and corrective wave structures from an Elliott wave perspective, I basically built the logic behind the technique or the principles of KCT using strictly linear or arithmetic charts. So that's why I tend to always default to an arithmetic chart versus a log scale chart. Okay, let me see. GB9, okay, thanks for the presentation. So I struggle with being able to decide between, okay. I struggle with being unable to decide between a wave ABC correction, RMN. Okay, oh, that's Moderna. Okay, here, let's pull up a chart from Moderna. Okay, what do I think about? Okay, now see, this is something you bring up, GB, thanks for bringing up the question. Okay, and we're going to look at Moderna. Ticker symbol is mRNA. Okay, and 9 times out of 10, whenever somebody wants me to look at a market, it's just, hey, Jeff, what do you think? What's the wave count? What's the wave count? What do you think? What's the wave count? Okay, believe it or not, I don't think that's the most important question to ask. The most important question to ask again, as a trader, my job as a trader is to make money. Okay, my job as an analyst is to analyze markets. They're not one and the same. And I think too frequently, too often, we confuse the two. We think that by being a good analyst, we're going to make money trading markets. That's not the case. Analysis is one set of skills, and it's based on your ability to look at a market and go through several different potentialities or possibilities and arrive at the highest one, highest probable one. The way you look at a market from a trading perspective, you're looking at different data. You're looking at risk reward, okay? You're looking at, do I have a trade set up or not, okay? Trading is a separate skill than analysis. I often like to say that analysis is the skill or the art of observation. What could happen? Trading, when I'm a trader, I have to focus on what is happening, okay? I know it's a very subtle difference, but it's a big difference. Just because I have the ability to drive a car does not give me the skill set to win the Daytona 500. Just because I have the ability to drive a car does not necessarily mean I have the ability, to drop the engine and change out the transmission. It's just not in the skill set. So they're two totally different skills, and that's important to understand. Now, in Moderna, again, I understand why the initial question might be, what's the wave count? When I look at this chart, I'm going, hey, the real question is, where's the trade? Now, I think in Moderna, what's kind of interesting here is off the high, I do think that this would probably be best identified as an ABC structure, okay? And you do have some volatility in that wave C sell-off. So basically off the high, you got a 3-wave decline. And I think within the wave 3 price move, 1, expanded flat 2, 3, 4, 5, most likely a truncation at the low here. Okay, so that's a counter trend move. I'm looking for new highs. Okay, so then we drive it down. Okay, let's start looking at the smaller term time frame. Okay, let's go all the way down to 20. Now again, I'm going to identify the movement here as a truncation. I think that makes the most sense because then we have 1, expanded flat 2, 3, probably a pop-up and 4. So what I'm going to be watching for here is movement up. I would like to see maybe one more small move higher here into next week. And then at that point, as we transition into early December, because again, that first week of the month is kind of like, the week I really begin looking for opportunities. Then we come back, maybe look at testing or closing that price gap that we saw right here. And then at that point, so bottom line, when I look at Moderna, I'm not necessarily looking at the wave count or trying to figure out how this move fits in with the price action over the last 1, 2, 3, 4 years. I'm looking at this market and I'm asking myself, is there a trade? Is there an opportunity for me to make money as a trader? Because that's my job. My job as an analyst is to count waves and look at divergence and interpret candlestick analysis. My job as a trader is to make money. Big difference. So in this instance here, Moderna, yes, it's going to be on my radar, but the sweet spot is this over here. So I'm going to wait for the market to come back to my sweet spot. And of course, I want to see that decline unfold in 3 waves. Okay, so GB, thank you for the question. Christian, you really need to wait for the earliest you can consider a zigzag complete would be if you have a 5-wave move above the wave 4 extreme of wave C. Good, Mohammed. Just, hey, there's not a rush. I think one of the biggest problems, Mohammed, we always make once we kind of get into what we're doing as analysts and traders, is we get excited and we start thinking, okay, man, look at all the opportunity. Every day there's opportunity. I gotta do this now. I gotta start trading heavy and hard now. My advice, slow. It's kind of like I was talking about a few weeks ago when I did that the lesson series based on what kind of lessons can we learn as traders from children's books. And the tortoise and the hare, slow and steady. Financial markets are not going anywhere. They're going to be here in 6 months. They're going to be here in 6 years. They're going to be here in 60 years, unless AI takes over the world. But my point is, don't be in a rush. What's most important right now, here, let me kind of explain something to you, and this is kind of a great metaphor or analogy. Several years ago, a buddy of mine got me into powerlifting, squats, deadlifts, that sort of thing. And for the first 6 months, he essentially refused to really, let me lift heavy weight. Okay, he was basically, very strict, very hard for the first 6 months, and he essentially forced me to lift only small, light weight because his whole priority was making sure I had proper form. Because if you have proper form, then the odds of having an injury just, drop down dramatically. But if you start going into a gym and just because you're all full of yourself that you start trying to deadlift 200 or 300 pounds or 400 pounds, you're going to blow your back out and it's not going to end well. I recommend the same kind of idea or attitude toward financial analysis and trading. I think a certain amount of time needs to be, you say you have to pay your dues. Go slow, be steady. Have that foundation, have that foundational knowledge under your belt. And then once you have the proper form down and you're doing it consistently with proper form, then that's when you can really begin to increase your weight as a power lifter or begin to increase your trade size as a trader. Kunal, whenever you're starting with a blank price chart, the best advice is begin the wave count from a significant high or low. For example, going back to mRNA, Moderna, going back to this price chart, I'm starting the wave count from a significant high, okay? For example, right here. That's where I'm starting the wave count. What I'm not doing is I'm not falling down the rabbit hole, okay? And I used to fall down the rabbit hole. And what I mean by falling down the rabbit hole is years ago, and this is like 1995 because I started at Elliott in 1993. Very early in my career, if somebody were to ask me a question about Moderna, I would say, well, hey, let me get back to you because I need to go here. I need to look at the quarterly price chart. I need to look at the monthly price chart. I need to look at the weekly price chart. Now, this is kind of easy to do because there's limited price action. But if somebody were to ask me about, say, the Dow Jones, I would be like, well, hold on. Let me go back to the weekly. Let me go back to the quarterly. And then let me go back to the year. Now, this kind of a chart, I definitely got to go to a log scale. Okay, so before I could actually give an opinion about a market, and it might have just been, hey, he only wanted to know what was going to happen over the next 2 to 3 weeks, I would spend sometimes hours dissecting multiple different time frames. So what I kind of learned to do is, hey, simply put, the most recent price action is the most relevant price action, so that's where I would begin your wave count. Okay, an impulse wave, Johan, will not have overlapping waves where if you're going to work a complex correction, a WXY, those waves will most likely overlap. That's one of the key characteristics of counter trend or corrective price action, overlapping waves. Eric, there are many different charting software programs you can use. You can go, one of my favorite charting software systems is CQG. But unfortunately, it's very pricey. It's like, a couple of grand a month. But there are some very less expensive softwares. For example, TradingView is a popular software that I use to look at the crypto market. That's also fine. It allows me to do what I need to do. But for what I do for Elliott Wave International and for Traders Classrooms and my commodity juncture service, I really like and prefer more than anything else Trade Navigator by Genesis. I think the colors of the charts, the ability for me to draw whatever I think is going to occur easily and quickly, being able to save a chart is easy and quick. This is a very friendly software for me to do what I need to do. So again, it really depends what your needs are and what your budget is. Rilwan, okay, how do you manage being patient and work and waiting when there is no good setup? Okay, hey, it's like going fishing. When you go fishing, you know, you get a rod, a reel, you got a, you know, a hook and a worm, and sometimes the fish are biting, sometimes they're not. And when they're biting, that's when you want to have 2 or 3 lines in the water, so to speak. When they're not biting, there's really nothing you can do about other than just simply call it an early day. This is why I think it's important to understand there are going to be times when the market it's all over the place. There's more opportunity to trade than you've seen in 2 or 3 months. That simply happens, and that's the natural ebb and flow of the market. For example, for those of you who are subscribers to my commodity juncture service, let's take, say, soybean oil, for example. Okay, bean oil, topped in a wave 3, we've been working a triangle wave 4. But that top in wave 3, and I think finally the triangle wave 4 is finally done. We're finally seeing some confirming price action in bean oils at the upside there. But the top of wave 3 occurred in June. Okay, and since June, the market has done nothing but go sideways, and a sideways market environment is not what I consider to be a very, say, high target, say, market environment. I don't think that there's a lot of opportunity trading a neutral, a sideways market. For example, because I've tried to get cute, I've tried to do that cowboy thing and trade triangles. And what happens is, okay, I've got my 3-wave move down that I think is a 4, so I go long. The market goes up, and I'm looking happy, I'm patting myself on the back, and then the market comes down. Okay, so now I'm thinking I'm wrong, maybe we're working flat, and the market starts bottoming, turns up. So I'm looking up, got it wrong, looking down, got it wrong, and then we go up and down a few more times as we form waves D and E. Well, by this time, what has happened is I've damaged my psychology. I've decreased my confidence in my ability and my wave counts. Okay, so whenever you see a sideways market, let the market break out and then play the breakout, because otherwise you're going to find yourself in a market trading that goes nowhere. You're going to be looking up when you should be looking down. You should be looking down. It's going to go up, and it really erodes your confidence and your psychology, so that when you need to be sharp and on your toes, you've missed the opportunity. Mohammed, okay. No, let me see. Mohammed, no, I'm an Elliottician, so I pretty much look at the market through the lens of patterns. But really, at the end of the day, I'm focused more on trades. Okay, where the trade levels are. Okay, Darren, let me answer the question this way. And the question from Darren is, do you see any value in using the fib levels based on log scale in TradingView? Sometimes those levels line up perfectly. Okay, I haven't done much work with Fibonacci on log scale. I've had to begin doing that recently, really this past year, when looking at some of the crypto markets, like Link, like Wait, excuse me, like link, chain link, like waves. Well, there are thousands of different cryptocurrencies that you can be trading. But because of the volatility there, it's almost like I've been forced into using log scale at times, and then, of course, using the Fibonacci on top of that. Phil, yes, some issues are too small and don't have options. That's right. Okay, hard pass. Yeah, I live life my way. I trade my way. I do what works for me. And if I look at a chart, in fact, a few weeks ago I was looking at a chart. I was looking at a stock, and I'm looking at this stock and going, dude, this thing's going up. I gotta buy it. Okay. Well, then I look at the option. Okay, and the option pricing was, get this, it was like $4.52 and $6.36. Dude, you can drive a bus through that spread. I'm not touching it. I don't care how profitable the trade ultimately turns out, but I'm not going to basically place a trade that as soon as it's initiated, I'm underwater. Okay, I want things to line up my way. It's my bat, it's my ball, it's my rules, and if the market doesn't want to play my game, I don't play. I go home, okay? So bottom line, yes, that's going to happen. You'll find great trade setups, but when you look to actually begin taking action on those trade setups, it may not be an optimal situation. So you may be looking at an option that has a really large bid-ask spread, in which case, hey, I'm going to pass. Not going to do it. Sergio, that's a good question, and I'm glad you asked, Sergio. Thank you very much for that. Sergio's question is, will 4 critical elements of high confidence trading course cover Forex? And the answer is unfortunately not, okay? And the reason why, it's not because the work I'm offering or what I show you, the tools that I show you to use, they're not applicable to Forex, because they are. But I don't trade a lot of Forex. So that's why, like for example, one of the things that I do in Trader's Classroom is that I share with you some of my own personal trades. Walking my talk kind of thing. I'm showing you what, hey, this is what I was looking at. This is what I traded. This is when I got in. This is what I got out. This is how much money I made. I go through my own personal trades with you in Trader's Classroom. Okay. Because I don't do a lot of Forex trading, that's why I really don't spend much time covering Forex. That's the only reason. Okay. Nalish, KCT, I think in the educational portion or part of the EWI.com website, there are some tools. I think I did a couple of webinars on KCT. That might be something for you to look at. Okay, you're in the CMT program. They talk about intermarket analysis. How useful do you find it? Mohammed, I think intermarket analysis is important. In fact, I actually shared a stage with Murphy. John Murphy is considered to be one of the fathers of intermarket analysis. Awesome gentleman, been around the markets for more years than I've put in. And I think the intermarket analysis is very, very important, okay? And I've mentioned this before. I do think intermarket analysis can be abused and misunderstood, but I do believe that there is very much something there. Now, the way I use intermarket analysis from a trading perspective is, say, for example, I'm looking at Delta Airlines, Delta. Okay, and let's say, for example, I see a potential trading opportunity, like, okay, maybe this is a triangle, again, and that's probably a big maybe. If it's a triangle, it would have to be a triangle that we would refer to as a truncated triangle, because waves C, D, and E are very small in comparison to the rest of the structure. Also, you've got your critical support levels clearly defined. you can tolerate or experience a move below the extreme of wave C, but not wave A. So I'm looking at this issue, Mohammed, and I'm thinking, okay, hey, Delta Airlines, okay, I see a bullish wave pattern here. Okay, so now I want to employ the intermarket analysis idea as they teach in the CMT program from the MTA, which are great. Those guys are great. I've done a lot of work with them over the years. So then I come over here, click a button, and I find, oh, well, maybe there's something going on with American Airlines. If Delta looks good, let's take a look at American Airlines. Or maybe we'll take a look at Allegiant. Or maybe we'll take a look at, say, JetBlue. Or maybe we'll take a look at, say, SkyWest. Or maybe we'll take a look at what? Southwest Airlines. Okay, so if I see something exciting in say tech stocks, then what I'll do as far as my intermarket analysis a lot of times is I'll take a look at other issues which are in the space. Okay, let me see. Luca, I'm so glad to hear that. Thank you very much. It's always nice to receive compliments, but more importantly, it's nice getting feedback that reaffirms that these tools and this approach, what I teach, does indeed work. So Luca, thank you for sharing that with me. I'm kind of pushing my limit on time, but let me see if I can grab a few more questions. Okay. Okay, Ramcour, does the sub wave counts and corrected wave counts must be satisfied? Yes. Okay, when it comes to the wave principle, it is very, very important to know, like the back of your hand, know the rules and guidelines of the wave principle. Okay, in other words, and really the easiest way to do that, if you're looking for just a short, quick, go to chapter 2 of the book, and whenever I say the book, I'm referring to Elliott Wave Principle by A.J. Frost and Robert Prechter. That's different than my book, which is Visual Guide to Elliott Wave Trading, written by Wayne Gorman and Jeffrey Kennedy. I'm talking about the book, Elliott Wave Principle by A.J. Frost and Robert Prechter. Then go to chapter 2 in the book, and then go to page 86 to, I believe, 91. And what Bob does in that section is he shares with you all the rules and guidelines which govern wave pattern development. So if you're looking at a flat, he lists all the rules and guidelines which govern the development of flat corrections. If you're going to do the wave principle, do it right, or don't do it at all. And here's why. The wave principle is a tool, okay? There's nothing magic to it. There's nothing hocus pocus or whatever. It's a tool. It's a valid, viable tool, okay? That being the case, whenever you get a tool, you read the instructions on how to use the tool properly. Otherwise, you might end up hurting yourself, okay? The same is true with the wave principle. If you do it right and really, you know, become a student of the wave principle, and it takes a bit of time, it takes a bit of practice, it takes a bit of skill, but you can indeed learn it. And if you do learn it, I believe that you're going to be right the market better than 80% of the time. Now, I had a few lessons a few weeks ago where I made mention of the fact that what is the one thing that can ruin good analysis? And that is poor trading. Okay, so you can have perfect analysis, know where the market's going, but you know, not trade it well because you're not managing risk, or you're trading too much size, or maybe the last 4 or 5 trades were losers, so you're looking to get back at the market and do what I call revenge trading, so you trade an inappropriate size. You totally, ignore your risk management rules, and that's how, poor trading skill can ruin good analysis. But if you're going to do Elliott, certainly take the time, learn how to use it properly, because if you do, I think you'll be very, very well rewarded. I don't have the time to get into cryptocurrencies. I apologize for that. Phil, good question. The PowerPoints will be provided to you if you decide to take the class. If you do, great. If not, then maybe this isn't the time for you. Maybe, say, the summer of 2022, might be a better time, but I do give you access to my PowerPoints. Having said that, I do not want to see my PowerPoints up on eBay at any time. And then also, too, each session will be recorded, so you'll have access to the video recording as well. Okay, that's about it for me. There's a lot of questions here that I did not get to. I certainly apologize for not getting to your question, but I really appreciate you showing up today, and thank you for being patient with me as I kind of do this shameless self-promotion on just sharing with you what, hey, the 4 Critical Elements seminar is really all about, because I've had questions. Like, for example, is there anything different in my 4 Critical Elements series that you don't talk about in Trader's Classroom on a week-to-week or a month-to-month basis? And the answer to that is really no. The benefit of coming to the course is the classes tend to be small. Usually, maybe 10 people, no more than 15. So that gives me a lot of time to work with individuals one-on-one. I do go into great depth on my own personal trades and showing you, okay, this is what a good trade setup looks like. This is a trade setup that is worth taking. This chart over here, it's ugly all day and you shouldn't trade it. You shouldn't even think about trading it ever, okay? So that's what we do. It's really geared more toward the trading aspect of what we do as analysts and traders. So in Trader's Classroom, I tend to focus more on analytical technique, how you can learn to identify high confident trade setups on your own. In the 4 Critical Elements series, I go into a little bit, say, greater depth and pull a lot of these tools and techniques together in a way that I think, what I've heard before from some previous students is like, hey, once I saw you do this, the light bulb finally went off. I finally get what you've been saying all year. So, okay, everyone, thank you so much for joining me today. As always, I really appreciate it. It's a pleasure. I hope to see you next week. If not, my feelings won't be hurt. I'll see you, in the weeks to come in Trader's Classroom. And who knows, maybe 6 months when I do the summer edition, you'll come back and revisit me then. Everyone, have a great day. Thank you very much. Happy holidays. And I will be doing a Trader's Classroom on Friday. And right now, I think my topic is going to be on my 2 favorite market timing techniques. Okay, everyone, have a great day. And as always, thank you very much.